Hi, Duncan. What are the big sort of global dynamics that have an influence on your portfolio, be they things like trade disruption, differences in monetary policy? How do you express them in the portfolio?
Yes, well, at the moment there's certainly a lot going on, a lot of things to focus on. We're fortunate at Bluebay that we have a big macro team who keep us constantly aware of the issues throughout the globe. At this point in time, what's happening in the Red Sea with the implications on particularly for us on tankers and shipping going through not going through the Red Sea and having to go around Africa, and the supply disruption that's causing industries and the opportunities that's actually creating. So that's a good example of some geopolitical tension that's happening, that's actually creating some dislocation, some volatility, and it's those factors that are often create the investment opportunities for us. So being aware of all these factors is an important part in the overall process of our investment process.
Bluebay operates predominantly in Europe. Can you give us a sense as to how you might look at the different geographies within Europe and which you would find appealing?
Yes, look, we're lucky that Europe's a big place. It's got a lot of different countries, and quite often there are different things happening across the region. If you go back 10 years, it was the Mediterranean countries that were struggling. Spain, Greece in particular, and Italy, and they were a rich source of investment opportunities for us in the stress and distress market. Interestingly enough, probably at the moment the weakest country within Europe is probably Germany. Which you would have never thought would be the case. And we're seeing a lot of corporates in Germany struggling at this point. And so we would expect to see opportunity set for us as investors, as I say, in distress and stress products, instruments, that Germany will be a source. And of course the UK, which is where we're also based, has got its own issues, some created by no longer being in Europe. So we're very lucky having so many different countries to look at, and the fact that they don't all tend to move in the same direction at the same time.
And similar question on different industries, which do you find most interesting and which are perhaps less so?
Yeah, we've worked really hard over the years to identify those sectors that we think could come under pressure, could have issues. It's particularly important. People think about investing in distress and stress as needing a big recession or big cycles, and certainly that can help. And I'll talk about that in a second. But if you think that some sectors actually struggle regardless of macro trends, so if you think about energy and shipping for the best part of the last, well, certainly the period 2014 through to 2020, lots of those sectors were struggling when actually the general macro environment was pretty decent, pretty strong. And so they were, that was a source of a lot of investments for us. As we look forward, I think plenty of people already this morning at the conference have been mentioning real estate. A lot of debt has been issued against a lot of different types of real estate over the last few years at very low rates. That isn't going to happen going forward. That is going to create a problem for those lenders. And that is certainly an area that we're keenly focused on. That's not to say that all real estate is bad. Of course, it isn't. There are good properties, there are good segments within the properties, but I think it's true to say there are certain segments, obviously office space, the obvious one that people are talking about, where we could see that there'll be plenty happening over the next few years, which hopefully will create some chances for us to invest.
Many people would perceive stressed and the whole concept of stress as being a difficult area for risk management. Can you give us some colour as to how you reduce risk?
Yeah, look, I often say what we do is not exactly rocket science, but there are a lot of stones to turn. You've got to be thorough. There are no shortcuts in what we do. You've got to be all over the documents. You've got to be all over the company, the sectors. You've got to understand all the factors. You've got to be comfortable with management. It's just a long list of things that you need to address. You need to work your models, your financing. So. Look, it's a detailed process, and the discipline that we have that we have to take. You can't take any shortcuts. I think the message that I like to say to people is, look, we're targeting pretty high returns. If we get most things right, we will generate good returns for our investors. The key to what we do is about making sure that when we get things wrong, because we're only human and things will happen that you don't expect and you will get things wrong, that you don't lose too much money. And people say, well, what does that mean? How do you actually do that? Well, how you do that is analysing and working out what the downside risk would be. What would your recoveries be if things didn't go to plan? So the real emphasis of a lot of our work is actually focused on that, trying to work out what the valuation of assets or businesses would be if things didn't go to plan, and make sure that that we pay a price for that instrument, that debt, as close to that price as possible, and B, that we're actively managing to make sure that we're always aware of if that outcome could happen. That's the key to actually. I think that's the key to what we do.
What do you think could be one of the biggest issues into 2024 or perhaps beyond that you want investors to think about?
Yeah, look, I think we're already seeing it. People talk about higher rates. To us, what that's led to is just a cost of funding issue for those companies that may have accessed the debt markets previously and been paying sort of mid-single digits, and that's that they could afford to do that. But the reality is those same companies today were probably looking at double-digit cost of funding. And if their leverage is too high, and for a lot of them it is, that just doesn't work. They're simply going to have to restructure their balance sheets. They're going to have to come up with some solution for their capital structure in order to survive. So if you're a CFO of a company today, in the next 12 months, if your debt's coming due, you've probably already sorted that out one way or the other. But if your debt is coming due over the next 2, 3 or 4 years, you're certainly maybe not sleeping too well at night unless you've got a clear path to a solution. So in terms of what does that mean, we would expect to see an uptick in the default rates over the next 2 or 3 years, not like we saw back in 2009 where it spiked very quickly and it was all gone. You blinked, you missed it. This seems like it will be a multi-year cycle of higher defaults, which will discriminate in no sector. It'll be across the board for those over-levered companies. So 24 will be, we've already seen it to some degree in the second half of 23. I think we're just going to see a continuation and acceleration of that in this year.
Mm. Well, out of that pessimism, there might be some optimism for fund managers such as yourself. Thank you, Duncan.
Thank you.